Now this is interesting. There's been a big debate about how independent the Federal Reserve really is, and Jamie Dimon gives a pretty good answer. The Fed is independent from the government, but it is not independent from inflation. When inflation was calm in early 2021, the effective federal funds rate was basically at zero, around 0.08%. Then inflation exploded. CPI inflation hit about 5.3% in June 2021, and later peaked near 9.0% in June 2022. The Fed eventually reacted by raising rates hard, taking the effective funds rate from around 1.2% in June 2022 to over 5% by mid-2023. So the relationship is not instant, but it is very clear. Inflation goes up first, then the Fed is forced to tighten. That is what Dimon is getting at. The Fed can be politically independent, meaning the president does not directly set interest rates. But if the government runs policies that create inflation, or if outside shocks create inflation, then the Fed is boxed in by the economy itself. It cannot just ignore rising prices. In the long-run data, inflation and the Fed funds rate have a strong positive relationship, around 71% correlation since the 1950s. But after 2020, the relationship works better with a lag. Current interest rates line up much more strongly with inflation from about 12 to 18 months earlier, because the Fed reacts after inflation shows up. So Dimon's idea is basically something like this. The Fed is independent of politics, but it is dependent on reality. If inflation is high, rates go up. If inflation cools, rates can come down. Credit cards are another aspect mentioned by Dimon. We've seen ideas from the current administration that there should be a 10% cap on credit card interest rates, which sounds extremely consumer-friendly, because most people look at today's credit card rates and think they're outrageously high. And honestly, the rates are high. Credit card interest rates were around 15 to 16% in the mid-1990s. Fell as low as about 11% in 2014, but then surged after 2022, reaching a peak of about 21% in August 2024. As of February 2026, they are still around 21%, so a 10% cap would basically cut the average rate in half. But what Dimon is saying is that credit card rates are not just some greedy bank behavior. They are also pricing risk. A borrower with low risk gets cheaper credit. A borrower with higher risk pays more, because credit cards are unsecured debt. So Dimon says a 10% cap would not magically create cheap credit for everyone. It would probably mean banks just stop lending to a huge share of customers. He called it an economic disaster, and said it could remove credit access for roughly 80% of Americans, hitting not just consumers, but also restaurants, retailers, travel companies, schools, municipalities, and all the places where people use credit cards to spend. The other thing Jamie Dimon is talking about is Trump's tariffs. This chart shows just how dramatic the U.S. tariff shift has been. At the start of 2025, the effective tariff rate was only around 2.3%, basically a tiny background cost in the economy. Then, after the April 2025 Liberation Day tariff hike, tariffs exploded upward and peaked at about 21%. Since then, it has cooled off, but not back to anything close in the past. It spent much of mid-2025 around 14%, and as of April 2026, it is still sitting near 11%. So United States effectively went from this very open trade regime to a protectionism regime. Dimon is saying that tariffs are not either good or bad. Some trade is tied to national security, and something might be considered unfair trade, and yes, in those situations, according to Dimon, tariffs or quotas make sense. National security, like pharmaceutical ingredients, antibiotics, or rare earths, are essential. If a country depends too much on foreign suppliers for those things, it creates a real risk. In a conflict or crisis, those supplies could be cut off, and suddenly cheap imports aren't so cheap anymore. Then there is the question of unfair trade. If another country is heavily subsidizing their products, making them cheaper, then domestic companies may not be able to compete with them. So Dimon's view is not tariffs are always good or tariffs are always bad. Sometimes they do make sense for certain situations, but probably not a widespread usage might be beneficial. We also want to make a little announcement in this video, and that is that we're providing you with our views on what we believe at Gleneus in this file, which you can download for free through the link in the description. The Real Economic Relationships is a deep dive into what really drives markets and economic growth in the world after 2008. The majority of the current research we see is using old methods and old theories, grounded in the old thinking of books. We have been able to avoid making those mistakes and came up with our own refreshed view of the world. Every era in human history has provided risks and opportunities. Some of them can be life-changing, and this file shows you the post-2008 dynamics. What we personally think at Glinius is that these points are quite precise and will have an impact on U.S. markets. Looking at the stock market, it's basically telling us something like this. We still think the Fed cuts, not hikes. The S&P 500 is trading around the 7,100 area, so investors are clearly not pricing in disaster right now. They are looking through the messy inflation data and betting that the next big move from the Fed is eventually lower rates. But this is also a very speculative environment. The rally has been sharp, and the key question is whether it becomes healthier underneath the surface. It is one thing for the index to go up because a few large stocks are carrying everything. It is much stronger if more stocks participate. Breadth has improved into the mid-50% range for S&P 500 stocks above their 200-day moving average. But for a really healthy continuation, you would want that closer to 60 to 70%, not just a narrow rally of fewer stocks. And this is where inflation and the Fed come back into the story. The Fed should probably be thinking about cutting rates if growth is slowing, jobs are not booming, oil is coming down, and core inflation is manageable. But headline inflation is still the thing keeping them cautious. Recent surveys show economists pushing rate cut expectations later into 2026 because energy and war-related price pressure are making the inflation picture uglier again. So investors are stuck between two ideas. On one hand, the economy looks weak enough that cuts make sense. On the other hand, inflation is still annoying enough that the Fed cannot just declare victory. None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.